8 days. That's how many times I traded this January, and it made me $108,000. Flash forward to February, $88,000 trading only as futures. And I only traded 14 days across both of those months put together. Now, today I'm giving you the entire strategy that made this possible for me. And I'm telling you, right now, it's going to be very boring. It's boring as hell. It's the same setup, the same kind of system, the same level, the same 3 triggers every single day over and over and over again. And it gets pretty boring. I don't predict shit. That's not how I go about trading. I don't come in with a bias. What happens is simple, right? I don't have an opinion on where price is going to be going. Structure is going to filter everything out for me, and order flow is going to give me the trigger, and everything else in between is going to be simple noise. I've been doing this for over a decade, and honestly, nothing was clicking, man. Like, nothing was working for me until I stopped staring at candles and started reading the actual buy and sell orders hitting the market live in real time while it's happening. And again, this has changed everything. Now, I'm not going to make any income claims here. Futures are risky. Most people who trade them lose money. Y'all can lose money doing this, and I lost about $25,000 in December before those 2 months. I'm going to show you guys all of that as well. So first, I'm putting the account up on screen so you can see this is real. You can see the receipts. Then I'm giving you the full method, top down, the way I run it every single morning before the New York session actually ends up opening. And then we're going to go through 3 real trades so you can watch the whole thing happen live in real time. Now, let's start with the receipts. January, $108,000, and I only traded 8 total days, 1 red day. We go to February, 6 total days traded, $88,000 made on February. January was the bigger month where we averaged 100K, and then obviously February is a little bit of a lighter month, but also only traded 6 days. Now, nobody expects this, but this is not prop firm account. This is a live account I'm trading every single day. It's not fake money sitting in a demo account. Real markets, real funds live in the market every single day. The dollar amount here really doesn't tell you too much, right? It doesn't tell you how many contracts I traded, what kind of setup it was. The dollar value really means nothing. We're going to get into what actually matters when we go through trade examples later on in this video. Now, I want to show you guys the reality of trading. Before this happened, I lost $25,000 trading in December. We traded 4 days that month only, realized price action wasn't great, wasn't for me, and I called it quits. The same strategy that made me $196,000 in 14 days lost me $25,000 in 4 days. And this is the same exact system that I've been using all year to average a significant amount of cash, ending off with July, where we almost hit $100,000. What happened in December, I want to talk about red months because I love talking about losses. Is what nobody talks about, but it's the reality of trading. Price action was bad, right? I was coming in from a very, very powerful month, made 96 grand in November. I was feeling myself. I was confident. First week of December opens up. Setups are not quite there. The action, price action is gone. Volatility is going crazy. And I lose my first 4 trades of the month. I'm down 20 grand on that first week. Second week opens up. I have a system to where if I lose money on a week, I size down the previous or the next week. And that's exactly what I did. I cut my size in about half, and then I lost 2 trades following that. 2 trades I should not have taken because I was coming in from a red week trying to make my money back, especially following a pretty powerful month. I entered when I should not have had, trying to make money back. I still make these mistakes even after doing this for over a decade. I'm going to repeat this again, guys. Let's count in total, right? We have about one, and again, we can't trade Saturdays, but we can trade every other day. So in January, we had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 28. At 26 days we can trade, and I only traded 8 of them. That is the core behind everything. Let's show it again, right? About over 20 something days in February, and only 6 of them were days I traded. So that means I had to literally sit for this week, for example, the 3rd week, I had to sit there for hours every single day and not do a single thing. This is what makes trading difficult, guys. And this is, again, the core thing that separates profitable from unprofitable is the ability to do this. I'm not making any income claims again, right? Futures carry risk, and most people actually lose money trading futures. I don't know who you are or what you're going to do with this information. I'm just passing down lessons on what I have done and what has worked for me. That's all it is. I don't know who you are. Now, that is the account I showed for you guys right here live. Let me show you guys the method in this strategy that was able to produce these results. Now, what actually is order flow? Order flow in simple terms is the orders coming in and out of the market in real time. And it's all kinds of orders we're talking about. We have limit orders, even canceled orders, market orders, stop orders, iceberg orders. It's every single piece that makes up the market is order flow. It's how the market moves. And we're going to go over every single thing I talked about here. Most people, when they're trading, they only look at something like this. They look at candlesticks. The thing about candlesticks is that they're only going to be showing you the results. They're not going to show you the cause of why this candle moved up, why this candle moved down, why this candle closed back in a neutral position. It doesn't show you why the move happened, right? It just shows you the result. Candlestick chart is showing you where price was in the past and where price currently is. That's it. There's no other distinction you can make from a candlestick chart other than just giving you historically what has happened and where price is sitting. It's not a lot of information. Now, people will often open up something like this, which is a heat map, right? Or a footprint chart. And they'll think it's astronomical physics, atoms, balloons, bubbles. They'll think it's some crazy shit, right? But in reality, every single bubble you see here, every single line you see here, every single number on the order book is a live, real order sitting in the market, either waiting to get filled or that has already been filled and placed. Every single number, every single thing you see here is a real participant on the grid that is giving you information. Now, I want to be honest, right? What this did for me is it let me stop guessing, right? That's it. It doesn't remove the risk. It doesn't make you right 100% of the time. It's not a God tool, right? That just prints money without doing any work. It's made me stop guessing. So to read order flow, to read exactly what I just talked about here, you're going to be needing two separate tools, right? Each one has his own specific job. And this is where I see people mess up. Now, I want to talk about Bookmap first, right? This is the absolute God tool. This is what I use a majority of the time when I am trading. It shows you a very similar concept to what the normal candlestick chart will show you, right? You see this, you can see price on the y-axis, you can see time on the x-axis, but it shows you so much more. Above the current price, you're able to see all of the passive sellers sitting there waiting to be filled. Beneath the current price, you see all the passive buyers sitting there waiting to be filled. So instead of assuming you have liquidity just because we're at a high, you can use the heat map to confirm that there is actual liquidity sitting there. What these green bubbles are going to be showing me are the aggressive buyers. All of the market buy orders coming into the market, hitting the ask, willing to pay a more aggressive price and getting filled. So you could see the number, the location, the time, the amount, all the above. And the red bubbles are just going to be the actual sellers. So right now live, the market just now closed, so it's super slow. You can see literally all of the orders coming into the market and how price is moving, how price is reacting to these orders, and all of the limit orders sitting there acting as liquidity magnets waiting to be filled. Again, a great look here. You can have the candlestick charts on the screen and then just see exactly where all the orders are sitting that act as a magnet towards price. And this is the crazy part. Most people that are trading have no idea what price even is or how price moves. And order flow is what's going to be determining price, right? When you're looking at Bookmap, you have these two lines you see right here, red and the green line. This is the best offer and the best bid. This is what determines when and how price is moving. A lot of you guys staring at this, let's say you want to take a trade, you see sell and buy, you see these two different prices on any chart you're trading, you have no idea what it is or what it means, but that is what makes price move. Think of it as a street market, right? A good analogy is the best bid. This green line is going to be the highest price any buyer is willing to pay right now. So someone is standing there saying, I'll buy it for 68.10. It's their best offer to buy. The red line is the best offer / ask. So it's the lowest price any seller is willing to accept right now, right? So someone is standing there saying, I'll sell it for this amount right now. It's the cheapest you can buy it instantly. And the gap between the two is called the spread. Since I'm trading ES futures only, the spread is so minimal because of the volume, the liquidity, that it's basically irrelevant to me. This is how price moves, right? So you see these two lines right here. You're seeing price move up and down, right? Between these two lines live right now as it's happening. What causes price to go from 34 to 5 to 75 to 35 to 35 to 35.5? Why is price moving? What causes price to move, right? So for example, the current price is sitting right here, right? Market buy volume of 1. This is the current price. There's 12 contracts sitting there. There's 16 contracts underneath us. For us to move down, all we have to do is see a market sell volume of 1. We'll move down to the next lower price. If we want to move down even further to the price beneath this one, we then have to clear out all of these 15 contracts. So for this to happen, we have to have market or at least 15 market sellers to clear all these contracts and then one more to move the market down. And this is what causes the market to actually move. move. And right here on the right side of Bookmap, you have the order book, which is also displayed to you by these dark red, orange lines. And this is showing you the exact amount of contracts sitting at the exact price point. So as price is pushing up, if we want to clear these 35s right here, we have to see at least 80 aggressive buyers show up to clear 79, and one will go above, and then price will then go into 35.25, and the same thing will happen. This is the battle between price every single day. This is how price is moving every single day. The next thing we use is going to be a footprint chart. Now, this is an awesome tool for analyzing the market. How you read a footprint chart is going to be very, very simple. It shows you a regular candle, right? So when you open up a footprint chart like I got right here, it's showing you, let me zoom out all the way so you can see, it is showing you a regular candlestick, right? But when you zoom into the candlestick, now you can see all the behind the scenes activity of what is actually happening at every specific tick of that candlestick. So it's very, very crucial. One side, you see all the aggressive buyers, and on the other side, you see all the aggressive sellers. So you see all the buyers hitting the ask, all the sellers hitting the bid. You also get the delta above the candle, which gives you the difference in the amount of aggressive buyers and sellers, and the overall volume of the candle, which gives you the total volume of transactions between the entire 5-minute, 10-minute, whatever candlestick you're using. So footprint charts are cool because you can actually change the durate or the candlesticks to do, 30-minute, 1 hour, 4 hours. So you can use and analyze footprint chart on a higher time frame, which is a lot harder to do on Bookmap. But these two tools, right, each of them has a job for me, right? Bookmap, I like to call it the God tool because for me, it's super overpowered. Showing you the level 2, it's showing you the liquidity, which the footprint chart does not. It does not show you level 2 data. It does not show you the actual passive participants. It's only showing you the aggressors coming in the market. And Bookmap shows you everything, which is why I love using Bookmap for execution and not as much for longer time frame analysis, but it's also great for those high volume levels. And the footprint charts are going to show you aggression. So it's great for analyzing the market pre-market while the market's open, long time frame analysis, because you can see exactly where the absorption happened, where the exhaustion happened, where buyers and sellers were aggressive, and a very, very pretty visual. For example, in this screen here is showing the same price movement, right? But as we push down into this level, we see sellers go from 900 to 89 to 58. We see sellers significantly slow down and die out, right? Because again, the delta is showing you the difference of buyers and sellers. So as we consolidate here, we're getting less and less aggressive sellers. Then we get this one big candle with 2.8 thousand positive delta, and the market starts moving up. Bookmap shows you the same thing. As we move down, what do you see here? You literally see the bubbles, the red bubbles disappear. You're seeing exhaustion on both sides. Then what do you see here? Green bubbles start to appear and move the market up. The same thing you watch on the footprint chart in different visuals, but here you also have these massive orders that got filled, so you can kind of see exactly what's happening. Now, these tools just give you information, right? They're not only thing you need to actually take a trade. All it's giving you is information. The structure, the system behind it is what actually allows you to be able to take these trades. So that's what I'm looking at now, right? Let me show you what to do with this every single day. The 3 screens, the 3 charts I open up every single day before the market opens. The first one is going to be getting the overall structure of the market. Now, keep in mind, this is a routine for me, right? I sit down every single day before the open. The first thing I do, the first screen I have open is going to be finding the overall market structure. And then I'll go down to the lower time frame, usually the 30-minute time frame, to find my key supply and demand and volume levels, and then we'll execute on the 5-minute time frame. Those are the 3 screens I open every single day. Super boring. It's a routine, but it's all I really need. So the first thing to focus on is the market structure. For this, I use the 4-hour time frame, and you have to understand the market is moving in 3 ways: up, down, or sideways, right? That's it. That's the whole thing. And I'm looking to read this structure on the 4-hour chart. 3 states, 1 chart. I'm gonna go through each one here for you. When the market's going up, making higher highs and higher lows, I'm looking to long, right, any kind of retracement or long any breakout of a last high, right? Because I think the market is going to keep going up. So if you break a new high, I think it's going to make a new high, right? And if the market's going down, same thing. I'm looking to short new breaks of old lows or new retracements into new lows. If we are in a range, a balanced market, right, I'm looking to long the bottom or short the top. I'm looking to play inside the range and never against it. So let me give you guys a quick drawing here so it makes sense. A lot of you guys don't understand balanced ranges, how to actually play or use this in a day-to-day basis. But if the market on the 4-hour is bullish, right, I'm looking to long any retracement or long any breakout of previous highs. And the reason I do this, right, is because on average, I want you guys to do some math here. All right, on average, zoom out onto any chart and do the math. The market spends way more time in a range, or in any market, the real estate market, car market, every stock, every option, every futures, it stays a longer time in a range than it does forming or breaking a new one. Not a range, we're also in a trend. So a trend or in a range, whatever you want to call it, same thing. So if I zoom out on this chart here on the 4-hour, first thing we notice, right, is the market is spending a vast variety variety of its time in a upper trend, downwards trend, or just in a choppy market overall. I want to align myself with the probability, align myself with the odds that we're going to continue the trend and play what the overall market is showing me. You've heard the term, the trend is your friend, and it very much is. I mean, recently we had literally the market be in an uptrend for months. All I was doing here is looking for longs. Then we shifted to a downtrend. And then right here, we have kind of a balanced range that we play the top and bottom of that we'll talk about. But it's important to remember, guys, that sometimes you won't have a range. Sometimes you'll have something like this, where it's making new lows, making new highs, and you don't know what's going on. That's totally okay. It's okay to not know what's going on, but it's not okay to act like you do and take trades anyways. That's how you blow accounts. But back into the range, right? If we're bullish on the 4 hour, I look to long any retracement or long any breakouts of old highs. If we're downtrending the 4 hour, I'm looking to short any breaks of old lows, or I'm looking to short any lower time frame retracements back down. And if we are sitting in a balanced range, right? Not only am I looking to short the top and long the bottom, but I'm also looking to play the middle. So that means if we just bounce off the top, I am looking to play any kind of trades in the middle back down into the bottom. I'm never trading against the structure. So if we just bounce off the top, I'm never looking for longs until we get to the bottom. This is something that I do every single day. So again, if the 4 hour is bullish, we're looking to break out any previous highs or any lower time frame retracement. If it's bearish, we look to short old lows for new lows and short any retracements on the lower time frame. And if it's balanced, we're going to play the range, right? Short from top to bottom, long from bottom to top, never against it. Another quick visual here, right? Shorting the top of the range, or we short any kind of, new lows or lower highs made in the range. Same thing from the bottom, we long the bottom of the range, or long any kind of higher low made in between the range or any breakouts in between the range as well. And structure is going to filter everything out. It's going to tell me what direction my trade should be, and it's going to tell me if I even should trade today. In order flow, it's what's going to confirm that entry for me. This is big for me because that's where order flow does its job. It's for execution and confirming your key levels. But now we know the direction, right? The next thing we have to do is figure out where the volume is sitting so I can align myself with the big money. I could follow the deep pockets, which is what order flow is letting me do in real time. And for this, we're going to be using supply and demand and volume profile levels. So the first step is identifying these key levels. And it's super simple, right? I do this on the 30 minutes. So I talked about my routine. I look at the 4 hour for structure, then hop down to the 30 minute to find my key levels. This is screen number 2. It's the 30 minute time frame. I do this every single day. So what I'm doing is identifying a big move down or a big move up. On the 1 hour to 15 minutes, sometimes I even go to the 4 hour. I'll show you guys all the time frames I use for these levels, but I perfect it on the 30 minute. I identify consolidation or a neutral candle, right, before the big move up or down. And this is where all the orders are being filled. I'm going to confirm this with order flow data. Now for demand, find a big move up, neutral period before that big move up, and then the top bottom wick of that move up, right, is going to be the bottom of the box. The top body of the candles of the consolidation or neutral period is going to be the top of the box, and I draw my box. Super simple. For supply, it's the same thing but backwards. Big move down, consolidation, right, top of the box, top wick, bottom of the box, the bottom body of all that consolidation. This one can be moved down a little bit. Then you draw your box, right? So let's go ahead and zoom out here so we can see any current levels we might have in the market, right? Zooming out to the 4 hour, what's obvious right now, we were in a bearish trend, but what happened? We have now been shifting into a bullish trend. So I'm looking for longs. Then I hop into the 30 minute time frame and I look to find any big move up or down. Right here, we see a big move up. So what I'm looking to do is draw a box. I have the magnet on, so I get the exact low of this big move up and the exact high of that body, right? If you zoom in, you'll see it's drawn perfectly. And this is my demand. This is where I'm looking to actually take the market long, bounce back and make a higher low to continue to the upside. I'll do the same thing for supply. Current structure of the market recently obviously has been pretty wild, but I'll do the same thing where I'm just looking for a massive move down in the market. One is an example right here, big move down, the consolidation using the top wick and the bottom body. And then I'm drawing my box, right? Again, this is a super powerful way to trade the market. It helps out significantly because you're following the big money. You're following where there's been big moves, which is what you want to do every single day. Once I know this, I hop into the 5 minute time frame and I'm just sitting there waiting for price to get into my key level. And if we're not around my key level, I do nothing. Again, this is the structure. This is showing me the direction of my trade. It's showing me the location where I can even start to look for my trade, and order flow is going to be what helps me execute. And again, it is super boring. It really is. Every good strategy is going to be this boring. And the days this strategy produces nothing, right, is the important days. The days I post about my free Discord all the time, because that's what matters more. Nothing more I love to see than a student not taking a trade because there was nothing there and him understanding that there was nothing there. But that's the routine, guys, every single day. The 4 hour, the 30 minute, and the 5 minute starts my execution that we're about to go over. And then most mornings I close the laptop and do nothing because there really is nothing there for me. And that is the part that I post along with my wins. I do free live trading Fridays on my free Discord, recaps, all the above. I post the mornings I sat out, the levels I'm watching, if I took a trade, if I didn't take a trade, my losses, my wins, the recaps, and trades that never gave me a trigger, right? Because if all you see is somebody's winners, you'll think that they're in the market every single day. It's not realistic, and you shouldn't be in the market every single day, but it's completely free. There's a link right down below. Just go in there, watch the video, see how many days I do nothing, right? Watch the recaps, watch the free live trading we do on Friday, so you can understand the strategy even better than this video can potentially teach you. All right, guys, let's lock in. We're going to be doing the triggers next to see exactly what causes me to press buy and sell. Quick recap, right? We're putting the two together. We know market structure. We know the direction to look for the trade, right? We know where the market might be going. We know where to look for a trade, but now we have to figure out when to actually press buy and sell. And for these, we're talking about entry triggers. The first trigger I want to talk about is the footprint chart stacked imbalances. Now, there's three ways I'm talking about in this video that I actually use to hop into a trade. This is only going to be the first one, the footprint chart stacked imbalances. So what a footprint chart will actually do is show you imbalances of buyers and sellers. So you will actually see, and the footprint chart will sometimes plot these for you, is these zones, right? These dark red and green zones. And what this is showing you is a diagonal divergence in abnormal aggressive buying activity. And you can use these to actually press buy and sell on your trades. Let me show you guys what this actually could mean. So right here, right, we know a candlestick chart showing you as a candlestick open, close, high, low. And this footprint chart has a lot more, right? It has all of the orders sitting in the market waiting to get, or that have been already filled, all the aggressors. We have the buyers on the right side, the sellers on the left side. And what these imbalances are going to tell me, right, is a diagonal divergence. So it's going to be moving like this, diagonally across the buyers, across the sellers. So if it sees 0 sellers come up, at one tick, and then it sees 1,000 buyers come up at another tick, then it keeps seeing this at least 3 times what my settings are set to, it will create an imbalance. We see at this level from buyers and sellers, we have seen an abnormal amount of activity from buyers and or sellers. Now, this is something I like to use to hop into my trade. So as the market pulled up into this key level, right, we had the 4-hour was bearish. We had, obviously a 30-minute we were in supply, and now I'm looking for an entry. And what we tend to see here, right, is the market pushed up into supply. We see buyers disappear from 300 delta to -400 to -1,000. And then we see these imbalances start to step up, right? If it's a green imbalance, it's an abnormal activity of buyers. A red imbalance is abnormal activity of sellers. And at the very, very tippy top of this candle, we get a green buy imbalance. We get trapped buyers. We can literally see at the very top of this candle, we had an abnormal buyer step up into the market and not get rewarded. And directly following that, we get aggressive sellers hopping into the market multiple times, and the market then flushes down and moves down. It went down even further on this trade. This is telling me that buyers got trapped, they got put under pressure, forced to close their position, so then the market has to flush down even longer. So this is showing me two things, right? One is a buyer struggling to move the market up, even though he was a big abnormal buyer. The market did not move up. And number two is going to be all these aggressive abnormal selling activity showing up and actually moving the market down and getting rewarded. Plus, I guess number three is going to be the exhaustion of buyers as we push up into supply. The second trigger is going to talk about exhaustion and absorption. So exhaustion is going to be first. Exhaustion is when you see one side of aggressive activity start to slow down. It's going to indicate a lack of participation as we keep trying to go in that direction. Price is still moving, but the effort is dying behind it. So you will literally see on a book map, for example, as we move down into a key level, the red bubbles will disappear. As we move up into a key level, the green bubbles will disappear. You can see it with your own eyes. The activity of buyers and sellers getting weaker and weaker and weaker. On Bookmap, exhaustion will look like bubbles getting smaller and smaller and smaller. On the footprint chart, you will literally see the delta of the candle getting smaller and smaller and smaller, or bigger, I guess, if it's negative. Now, the next one's absorption, right? And on the heat map, you're going to see long time frame resting orders. So it's going to be massive orders that have been sitting in the market for a very, very long time. On the heat map, it will look a little something like this. So you will see these massive orders that have been sitting on the tape for a very, very long time, or you will see an iceberg order, and you will see aggressiveness. You see massive bubbles actually hammer those orders, get filled, but fail to break through. You'll see heavy one-sided participation that does not move the market and does not get rewarded. It's also a good signal for a reversal in the direction of the absorber. So meaning that if we are hitting a key level, let's zoom out here. If you're seeing price hit a massive wall of orders, right? We come into this wall, we're seeing massive amount of aggressive buyers hit this wall. We don't move up. We fail to move up, and there's still leftover passive sellers, showing us that there's more passive sellers than aggressive buyers. The passive sellers were able to absorb all those aggressive buyers, failed to reward them, right? Indicating a trap participant. Then it's a great reversal signal for the direction of the absorber, which is the sellers in this instance, or this shitty drawing example. It will look like this on Bookmap. You will see massive bubbles, fill orders, still orders left over, and then no follow through or participation afterwards. On the Bookmap, you'll literally see it by bubbles not moving the market down. On Footprint chart, it will be massive delta that does not move the market up or down. An example right here on footprint chart that happened today, you see this candle with 1.7 thousand positive delta. Most of the volume is going to be on the upper hand side right here, told by the histogram, and price did not move up, right? This is absorption. So on footprint charts, you have to assume absorption because you can't see the liquidity that you can see on heat map. So you have to assume if there's high delta and price does not move up in that direction, what is that telling me, right? Potential absorption. It's actually a trade example I may be going over in this class is a break retest, right? Showing you that we had aggressive sellers come in, move the market down. Then we get almost 3,000 combined positive delta that closes neutrally and fails to move the market up. This is absorption. This is actually something we use for a trade we took very recently. Now, the third trigger is going to be the shift, right? This is going to be combining these two triggers together, or absorption and exhaustion together, for a powerful trigger. You can use just absorption, you can use just exhaustion, but when you combine them, you combine this with the third trigger, which is going to be aggressive follow through. It's very, very powerful. So you're waiting for a zone to get hit, obviously. Then you're starting to look at the actual data, the actual orders, the actual order flow to take your trade. So as we push down into this level, the first thing I notice is going to be exhaustion. We see literally the red bubbles just disappear and green bubbles start to show up. Notice how on this whole move down, we didn't see a single buyer take control. And what I mean by take control is fill a passive sell offer and make bids above price. We see the exact opposite. On this whole way down, we're seeing sellers take out passive buyers and make new lows, telling us they're in control. Then we get a switch, right? We then see sellers disappear. And then right here is what I call aggressive follow through. We're waiting for a buyer to fill a passive sell offer and make aggressive move above that offer, showing me that they're now in control. This is how you combine absorption and exhaustion with aggressive follow through for my third trigger, which is actually my most powerful trigger. It has the highest win rate is by waiting for these conditions to actually hit. Now, this is what's cost the beginner traders the most amount of money, right? Price just getting to your level means you're allowed to start looking. One of these three triggers for you has to fire before you actually touch anything. And without that confirmation, you're guessing, you're gambling, right? Sitting at a good level with no trigger and clicking buy is how people lose money or have a terrible win rate on a level that was actually right? But there's no trigger, there's no confirmation. If you add these, you'd be surprised how often or how less often you end up getting stopped out and faked out. Now, these triggers and these confirmations do have a pretty high win rate. I mean, you can get away with just a 50% win rate, right? If you're risking the right amount of money. So with the 50% win rate, if you're risking a 2-to-1 every single time you take a trade, meaning that if you're risking $100, paying me to make $200, you'll be profitable in the long run. It's a game of probability. It's a game of large numbers. You can be profitable with a 30% win rate, right? If you risk a 1-to-3, you can be profitable with a 20% win rate if you risk a 1-to-5. So the important part about risk and how you actually manage this is how I do it, right? A lot of my setups are above 50, above 60s. I'm even close to 70. Size, target, and the point amount of stop loss and take profits are dynamic. They're not static. It means they're changing. They're not always going to be the same amount every single time or the same amount of points. It depends on the VIX, the different headlines, right? If the VIX is high above 20s, we have wider moves in the market, so my risk in points is going to be wider. It depends on the setup, the confidence. So if a setup has a higher win rate, I'll put more risk down. I'll put more size down. A good analogy is you guys know those gamblers who get banned and kicked out of casinos because they play probability. They know exactly how to beat the market, how to beat the house, which again, the market's the house. You're the gambler and you have to be the ones who get kicked out, not the ones who go in there trying to get lucky. But when the count is in their favor, right, they'll bet more money. Same thing with me. When there's a higher chance of this trade working out based off my data, I will bet more money. But I'm mostly going to be going for a 2-to-1 and risking about $8,000 to $16,000 per trade. Now, let me talk about what I mean by static and not dynamic. So if we come down into demand, right, or sell off into demand, and then we get a move up, right? This is the first scenario. Let's say second scenario, come down to demand and we get this move up. Now, if I see an entry trigger all the way down here, right, versus if I see an entry trigger all the way up here, let's say for both these trades, we're targeting these pre-market highs, whatever it is, my stop loss location is static. It's always going to be, in this instance, at the low. It's going to be on invalidation where my thesis is invalid. If I'm going long here thinking the market is going to go up, right, and we come in and make a new low, I'm wrong. I want to get out. So my stop loss isn't going to move based on how much money I want to win or lose. It's going to move based off of where the invalidation is sitting. So let's say I get an early entry trigger here and I only have like 10 points worth of risk, right? Versus my later entry trigger here gets me about 20 points worth of risk. But the R&R is still going to be over 2-to-1 for both of these. On this instance, I'll be able to bet more contracts because the distance from my entry to the stop loss is only going to be 10 points, right? Let's say I only want to risk 10K for this setup, right? This distance, 10 points away, cool, enter, stop loss, I'm good to go. This scenario, number 2, right? I see an entry trigger a little bit later where my risk is now 20 points, but the R&R still makes sense. What I'll do is I'll cut my size in half. I'm not moving my stop loss. I'm not moving my take profit. I know how much I want to risk per this setup. So to get that amount of risk, I then will adjust my size. The only thing you guys are changing here is where you enter and your size. The stop loss stays the same. The take profit stays where it has to be, but the value of points And the distance of stop loss and take profit is what's going to be changing. And that's what you have to adjust your size to. It's kind of what I do. All right. So you have the structure, you have the zone. Now you have the trigger and then the size, right? It's super, super simple. Now let me put on some real trades, guys, because on paper, this always sounds cleaner than it actually is. Let's just go ahead and check it out. For these trades, all I do is put it all together, right? I follow key market structure. So I'm always with the overall trend. I'm finding the key value areas. It's going to be super boring. I'll show you guys how similar these trades are. And the 3 entry triggers I use to actually get in and take the trade. Now, remember I showed you guys the profits, right? 24K in this day. So I'm showing you guys a trade where I made $24,000. That profit doesn't matter. I could have, risked 100K to make that. What matters is this right here, right? ES future trade, I traded 20 contracts at an ROI of 1.2%, just basically the percentage of my total count, made $24,000. It was a supply bounce short, right? And the key part is here. I risked $7,500 to make $24,000. It's almost a 3 R&R on this trade, right? So I risked this to make this. This here is what matters. Nobody cares about the P&L, right? What matters is how much you risk versus how much you make. Because if you can master this right here, you can trade making 10K a day versus making $100 a day versus making $100,000 a day. It's going to be the same thing. Just your size is going to go up, right? But what is different and what has to stay consistent is how much you're risking versus how much you're making per that risk. So for this trade specifically, a short trade off supply, right? My stop loss was at the 81s, had 3 targets for this trade. I'll show you guys all the targets targeted 63, 52, and 37. My average entry was 73. So from 73 to 81, had a decent amount of points of risk. Average exit was 49.49, combining all the runners. And then I entered at 9:51, exited at 10:25. So I was in about, 30-ish minutes in total on this one specific trade. Let's go through the entire trade. First thing we do is obvious, right? We look at the 4-hour time frame to see what it's doing, what it's happening. And in this 4-hour session, we were in a semi-balanced range. It was a very ugly 4-hour session, very strong key level here, but the market kept making these equal highs. And I was treating this as a balanced range for us to keep zigzagging back and forth on the 4-hour time frame. You also see right here, you have this 4-hour demand or supply that I started off with, and I actually zoomed into the 30-minute time frame to actually mark it out, make it even better. So remember, my entry was around, stop loss was 81s, entry was around those 73s. That's exactly where the supply level was, right? From 72 all the way to these like 90 somethings. And that's exactly where we ended up taking the trade. And then we zoom into the 5-minute time frame. This is what I'm looking at to actually execute. We're in the 5-minute time frame. The 5-minute time frame candlesticks looked like as I was actually taking my entry. Now we watch order flow because this is what we now need to actually execute. Remember, right? Everything else had a click, the 4-hour, the 30-minute, now the 5 minutes there for me. Now I can start looking for an entry. Now the market then opened, right? And this is the open of the market. We see a trapped buyer at the very, very top. And if we kind of zoom out a little bit more pre-market when we're seeing all this consolidation at the same high, what I then see, right? This wick comes up, takes out these highs, and we get a trapped buyer at the very, very top. A big buyer does not move the market up and starts to sell off instantly. The next thing we actually start to see is we had this exhaustion previously. So before this consolidation right here and right here, we had exhaustion from buyers. We kept trying to move the market up, but the buyers kept getting smaller and smaller and smaller. So something that I also was watching out for when the market opened and we're getting to that key level. Now, this changed stuff for me, right? Because as the market opened, we get a big aggressive seller, no follow through, and a big aggressive buyer with no follow through. So now we're kind of in a really tight range where we have an aggressive buyer above and an aggressive seller below. So for me, this was a key confluence, is seeing who is going to get the follow through, who is going to get trapped, and who is going to see follow through. And instantly we see the market then reward these sellers, push down, make a new low, and see more selling activity underneath this seller. So for me, I'm confirming the seller is not trapped, the buyer is trapped, the market is now moving down. I should continue with my short bias. So let me show you guys again. Remember what we had here before, the exhaustion. So not only do we get a trapped buyer, aggressive seller coming in and actually seeing lower prices, we then retest that supply level. And now that we're retesting the supply level, what are we seeing again? We're seeing exhaustion of buyers as we're retesting that supply level. This is what it looked like on the footprint chart, right? Market opens off, you see this big green bar. That right here is the trapped player. This big red bar right here, that is the seller that actually ended up getting rewarded on that 5-minute candle. So for me, that was all I needed to confirm my short bias. We then also see the market move back up, try to retest that supply, but we see the delta go from negative to positive 300 and instantly shift back to negative 400. So that's the exhaustion we're now reading on the footprint chart. And this is what I used for my entry, right? I actually entered into this trade a little bit late. I hesitated. I should have gotten a better entry and actually entered up here once I saw the exhaustion. But I was hesitant because I think this was actually following a red day where I took a very similar setup that didn't end up playing out. I still make mistakes, right? It's very, very common. But what I did enter this trade is after I saw the exhaustion, we also had a floor. So we had another range within a range. We also had a floor of sellers that failed to break the 74 level. So whenever I saw sellers shift structure on the tape on Bookmap and break underneath these lows, I then entered my trade. I should have entered it off the exhaustion for a better entry, but again, I did end up hesitating. And then my targets were simple, right? I saw the VIX expand as we were moving down. For me, that means, right, that we're going to have a wider move in the market. So I targeted the pre-market lows, I targeted the yesterday's New York open lows, and I targeted the pre-market lows from the previous session as well for 3 total targets, and I got out of of all three of them. Final target got hit down here for a really, really good day. To keep in mind, guys, this is my pre-market plan I posted that day. This was a level, right? I'm watching supply in the 758 or 7580s and the 7600s closely for shorts. This is a level where we've seen massive absorption from buyers and aggressive sellers step in hard multiple times, right? And again, what do we see on that first candle at the open? Negative 1,000 delta that gets rewarded. So I was watching this level before the market opened. I posted this before the market opened at 924. I knew what I wanted to see before the charts were even open. Now let's talk about trade number 2. I took this one recently. Actually, it was $19,250. I left a lot of money on the table for this trade. Actually, I'll talk about. It was a short trade because recently the market has been bearish. We traded 20 contracts total. Again, $19,250 made. It was a supply bounce. This is the key part here, right? I risked 9.7K to make $19,000, right? About a 2-to-1 R&R, almost 2-to-1 R&R. So exactly what I'm looking for every day. My stop loss at the 480s up here on invalidation. My first target, my only target was actually should have held runners was down here at the 51s. We'll talk about that. Average R multiple of a 1.97, about a 2-to-1 R&R. Average entry was 70.25, so about 10 points from the stop loss. And then entry time was 10:10, X time was 10:27. 17 minutes in this trade, hit full TP, walked away, did what I wanted to do with the rest of my life or the rest of my day. But the structure during that trade, which is actually right here, was bearish. 4 hour, you see us putting in new lows, putting in lower highs. So remove this part. This is where I entered for the market open. We were in a bearish 4 hour. And this was the key level. So this is actually interesting because I haven't talked about this. We gapped up overnight, meaning that this supply level for me was not invalid. So when we gap up like this, I still have that supply level. So as we came back down into it, I was then waiting to see confirmation that sellers are going to step up again, because again, it's a significant 30-minute supply level right here. You see this consolidation, this neutral candle before this move down. So what I did was wait for us to get to this level and then finally take shorts when I saw the entry trigger on the 5-minute. This is what the 5-minute chart looked like when and before I actually ended up taking my entry. And now let's talk about what we saw in the market, right? So before the sell-off pre-market, what we see is the market moving up, lack of buyer participation. In this candle right here, right, as soon as the market opens right here, we get 31,000 volume with 600 positive delta. The market then moves up a little bit more and we only get 300 delta. So the positive delta gets cut in half, and then we get an aggressive seller coming to the market and really pushing new lows and close all the way down here. Then we get buyers try to step back in again, right? 400 delta, and then it goes to 52 delta. So they get more exhaustion of these buyers. And then we get another massive aggressive seller to then dump and move the market down. That is how the market looked as soon as it opened to me, right? It's exactly what happened. I was like, dang, okay, we're pretty aggressive. We're selling off. There's a gap fill underneath this. We're about to hit supply. My thesis, the 4 hour is short. We're about to hit a key level. I then now want to watch for shorts. And now what we do see, right, as we actually took our entry, this right here is showing me this right here. I use Bookmap for this, but I'm going to show you both. We get 30,000 volume with 2K positive delta, then 800 positive delta. So almost 3,000 positive delta. The candles close neutral and don't even make a new high. Keep in mind, this 1,000 delta candle moved all the way down here. This 1,000 delta candle moved all the way down here. Then we get 3,000 positive delta and the market fails to make any new highs. And then following that, we get an aggressive sell side imbalance. So you could have used the Bookmap chart for this entry, right? But just keep in mind everything we talked about. This is what the market looked like on Bookmap at the open. We aggressively sold off, see absorption, aggressively sold off, see absorption, aggressively sold off, see absorption. That was the pattern of the whole day. That's why I did leave some money. But what I did, right, once we came into my supply, this is literally this right here is this right here. Same thing. We see all these green bubbles, but now I also see this wall of offers at the 80. So this is a nice place where I was comfortable to place my stop loss to protect my shorts. We get all this absorption, and then we get an aggressive seller filling this offer and then making aggressive bids underneath price right here. And that is when I placed my sell. I pressed sell as soon as I saw that. The absorption, everything else for me clicked. We broke the floor. I press sell and I take the market short and I target the very, very top of this gap. Now, for this trade, I actually was very sick for this. I woke up, I was feeling like shit. So I took the trade, I closed my laptop and I went back to bed. Looking back at it, I should have stayed awake. I should have been watching because I missed out on a lot of money. The VIX was expanding like crazy. I could have held this all the way down to the recent lows, making almost $30,000 in this trade if I would have just, stayed awake and watched this, but I was sick. Can't blame me. I don't really like trading when I'm sick, but I did leave money on the table for this trade. Now let's talk about the third trade. Again, they're all shorts because obviously the current market has been bearish. This trade was following a loss. So I did attempt this trade before. You see it here. I took a loss. I think it was a total of $9,000 on my first attempt here. Talk about that trade as well. But the key thing here is, right, I took a second entry, but I hesitated. So that affected the data specifically because I planned and realized our multiple was 1.7. No, I risked 16.2K on this trade to make 27K, less than a 2-to-1. It's still not bad, right? But it's less than the 2-to-1. And this happened to me because I hesitated on my entry. I'll show you guys right now what I mean. Again, I hesitated on my entry for this trade. And I do that sometimes, especially I want to show you guys a transparency. So I want to show you guys the trades where I actually end up messing up and not being fully perfect, because that's the reality of trading. You're never going to be perfect. perfect. But we got in late, causing us to risk a little bit more than we wanted to. Still a good trade, still a dub trade. And then we got in at 9:55, exit at 10:13. So again, about 18 minutes in this total trade. So that's why I trade the New York Open. I want to be in and out as fast as possible and do whatever I want with the rest of my day. But that was the trade, and we'll talk about everything that happened in between. So we're looking at the 4-hour. It was, again, obviously bearish, holding the lower lows, holding lower highs. We knew we wanted to short. 30-minute, we have a very strong, obvious supply. I mean, look right here. Look right here. Look at the reaction we had twice. Very strong, a very obvious supply we're looking to use. And then on the 5-minute time frame, what we do is, this is what it looked like as soon as the market opened, right? We tapped the supply level, and this is exactly where I was looking for my shorts. This is what the footprint charts look like on the way up. First candle of the open at 50,000 volume with 4,000 positive delta. Then it went to 700, then went to 1.9K. And as we got to the very, very high, we see delta go from thousands to 100 to 300. So we see exhaustion live happening in the footprint chart, and a massive seller hop in with negative 3,000 delta and start moving price down. So this is what price looked like as it opened on Bookmap. All these aggressive buyers sold off, all these aggressive buyers. And you see here what happened, right? You get a nice exhaustion from the buyers. Let's zoom in a little bit, because this trade, it was based off iceberg orders. And what iceberg orders are in simple terms, right, is going to be this. And these are basically participants trying to hide their orders. You see a small block of orders sitting above or below price. Market comes in, right? It fills all these orders, and then instantly see orders get rebid instantly, right? As soon as it gets filled, you can see them get rebid, and it comes back in and fills these orders. What this is, why they're doing this is they're trying to hide their position size. They want to get into a massive position, but they don't want to show their full hand. So they place a little tip of the iceberg, and as these orders start to get filled, they put more and more down, so people don't really see it. It's a massive manipulation tactic that they do use almost every single time. This is what I did, right? We came in, so I saw the iceberg order form. So I saw all these buyers fill these passive sellers, come back down, they got rebid, all these buyers start to fill. And then we start to see right here a structure shift on the tape. We start to see a first time a seller is filling these orders and actually putting in new lows underneath price. And then all the orders get canceled. We see price then go back into where we had that previous iceberg, or we'll go back into supply, and then we get exhaustion, right? And this is why I hesitated, because I honestly should have entered this trade once I saw this break right here. And again, I would have put my stop loss above this order at the 90, so I would have been still in this trade. Whenever I saw this break here, I should have entered, but since it was falling a loss at pretty much a very similar level, I hesitated and I waited. And market then came back up, right? I then get that exhaustion again. I get the trapped buyer at the very, very top. And at this point, okay, like we get a big buyer at the top. I want to make sure he's trapped. I was coming from a loss. So I wait for the market to come back down, fill this offer right here, make a bid below price. And that's actually when I press my sell button. My stop loss was originally at these highs right here. And then I target a pre-market low right here. So I target a view up first, then a pre-market low we have right here. And I fully get out of that trade. Again, this was a level that I called out before the market opened at 9:16 a.m. My main focus is watching ES at 7480 supply, which is what we see right here. And that was my bias for the day, right? So again, it's very boring. It's literally the same thing every single day. And guys, remember, right? Remember January, 25 days, only 8 of those days that I traded. So meaning almost 15 days, I didn't take a single trade. Again, about 20 something tradable days in February, and only 6 of them were traded, right? About 40 days total in 2 months, and I only traded 14 of them, right? So again, it's almost 20 something days I just didn't touch anything at all. And those are the days where the strategy was doing its thing, right? It was doing the job, but the structure did not line up, or the trigger never fired, right? It's very, very key here. Because a lot of time, and what it feels like, right? You're sitting there, the market's moving, and you generally have no idea what it wants to do. So you don't trade, you sit on your hands. That is the most important thing, the most important skill you'll ever be able to learn. I want to repeat this again, because it's okay to not know what's going on. It's okay to look at a chart, right? And have no clue what the market is doing, or what the market wants to do, or just shoots up all the time without you. But it's not okay to pretend like you do, to sit there and improvise and think that you know what's going on because you see a big red bubble and take a trade. Again, that's how you're going to keep yourself unprofitable and inconsistent year after year. I was there for literally 3 years. Sitting on your hands and waiting for A+ setups is the single biggest thing that's going to separate the profitable traders from unprofitable traders by a very, very far distance. Flashback to December, where I was coming from a really, really good month. My confidence was up, my ego was up, ended up losing 25K in 4 days because I was doing things I wasn't supposed to do. I knew action December historically was wrong. I lost money the first month, and I was trying to make it back or the first week, and I was trying to make it back the second week, and things go wrong. For me, things go wrong when I do not follow a very strict plan that I have every single day. So, this is the days where I want to do nothing, right? Let me tell you what actually makes the money. But it was one idea 14 times. I never improvised once. This is super, super key, right? Because you have to shift from I need a sharper read to repetition is the thing, the one sanctioned thing in the entire system or strategy you're trading that actually helps, that actually makes a difference. Nothing else matters if you don't have that locked in. I didn't hold anything back in this video, right? Most of you guys came here in this video watching for the tool, right? They think the gap between them and a profitable trader is a sharper read on the footprint chart or a sharper read on the heat map. The God tool or one more thing on the screen, super, super key, man. I want to do the count out loud again with you guys, man. 40 some trading days in between January and February, and we only took 14 of them. 14 days out of 40 days sitting right there. What actually ended up making me the money. January on its own, 8 of those trades, right? $108,000. Same trade, same exact thing, right? 14 times combining in February with $196,000 total, almost 200K in those 2 months doing the same boring thing. Because the edge is never how good my read is, right? It's not that. It's that I ran the exact same trade 14 times and I never improvised once, right? And never improvising means I'm not waking up, not being at a key level, seeing a big order pop up on Bookmap and just following it blindly because I want to place a trade. I'm not looking at the market and being like, oh, the market bounced off of here 3 times, so it might bounce off again. Let me just hop in this trade. No, I have a plan, right? The same 3 screens, same 3 time frames, same levels, same triggers, same size, no new idea mid-session. And again, if this trade was not part of my pre-market plan before the open, I'm not taking it. And I have improvised before multiple times. It has cost me. I got cocky. I'm thinking my read of order flow is amazing. It's God tier. I'm always right. So I'm just watching order flow. I'm watching these big orders come in and I'm trying to follow them. And almost every single time it costs me money. Again, I have the data to back this up. That's why it's boring. There's nothing to decide. I'm not predicting anything. And there's most days I literally sit there and do nothing. Like, I mean, again, guys, look at February, a whole week where I took 1 break-even trade. That would drive most people crazy, but that's what it actually looks like from the inside. This is what's worked for me over 10 years, right? I'm not promising anybody anything, and people lose money trading all the time. A majority of them lose money trading. Now, guys, Bookmap right here, right? The God tool, right? The tool in this video that y'all learned, I never really stopped to teach, right? Because there's zones, there's 3 triggers, there's the 3 real trades. And the one thing I kind of blew straight past today is Bookmap itself, because it can get pretty crazy because trigger 3 is using Bookmap as the God tool. It has everything you need to actually take that really high win rate trigger. And I gave you guys about 90 seconds on it, but it has its own video sitting on this channel and it's up right on the screen right now. Go watch that one first, right? Then paper trade, use demo accounts, buy a cheap eval first with this exact setup until it literally generally bores you, and only then put real money in. Start buying and trading more accounts. Till then, don't put any money near it, guys. Do that for 2 weeks and you'll start to see the strategy actually start to work. I'll see you guys in that one video.